Hey, what's up traders? My name is Rainer and welcome back to this week's market analysis. So this week, I would like to share with you what I think is actually the hardest market to trade right now. That's right, there's this particular market which I think is actually the hardest market to trade, coming from a trend follower perspective. And also I walk you through a couple of trading opportunities in the market, namely the New Zealand dollar as well as a copper setup that I'm currently looking at. So all this and more in this week's market analysis. I'll see you there. Okay, so the hardest market that I was actually mentioning about is actually none other than the S&P 500. So let me explain why, right? But this is actually coming from a trend follower perspective. So if you are someone who adopts a different kind of trading methodology, right? Perhaps the S&P 500 could actually be a favorable market for you to trade. But for me as a trend follower, I would say this is a nightmare for me. And let me explain why. So looking at the weekly chart, right, it is no doubt the trend is currently in an uptrend. We have a series of higher highs, higher lows. Then you see price respecting the dynamic support over here, which is actually the area in between the 20 and 50 period moving average. So all is clear on the weekly chart. The trend is up. However, looking at the daily chart, right, for a trend follower who is looking for a long opportunity, right, this is where the problem comes in. So basically for a trend follower, I would say if you're someone who trade the trends, right, usually you will get one of two ways to enter the market. Number one, you trade a breakout, and number two, you trade a pullback. So these are actually, I would say, the only two entries that you could use to trade the markets. But let's see how these two entries is going to create quite a bit of problem for someone who is trading this current trend on the S&P 500. So looking at which, let's look at the breakout scenario first. So let's say, for example, you identify the trend is bullish, you had a buy stop order over here, and you went long on the breakout. So you got the breakout over here. Price rallied slightly higher, and the next thing you know, you get stopped out as price traded lower once more. Then after which, you got stopped out and you think, all right, maybe breakout wasn't such a good idea. You identify this key support over here. You think that perhaps price could bounce off from this level. So you got long at this support, and guess what? Price push you down even lower, stopping you out. And the next thing you know, you stage a strong rally all the way back up. So basically now you are down two trades. You traded the breakout, you got stopped out. You trade out the pullback into this support area, you also got stopped out. So perhaps right now, you may be thinking, the trend is still intact. You still want to get long. So you attempted a breakout long scenario over here. And price rallied slightly higher. And if you are not too, I would say, too conservative with your take profit targets, or I would say you did not set your trade to break even, chances are you will get stopped out once more as price retrace very deeply against you. Then right now, I would say most of your emotional state of mind is pretty much negative, right? This breakout, price did another breakout once more, and I'm not even sure whether you would have the courage to go and execute the breakout. So at this point in time, you have three losing trades, all because, you traded with the trend, but just that in this particular scenario of the S&P 500, the trend is not very clear-cut. We see very steep pullbacks in the market. We see the breakout is usually followed by a retracement against you, so namely what we call a false breakout. So you have a lot of false breakout, you have a very deep pullback in this market, and it's actually a very tough market to trade. And going forward, you can see, the price action is still very similar. You see we have another false breakout over here, another false breakout. And when you want to trade the pullback, sometimes the price does not come into this key area that you're looking at. The pullback just come towards here, bounce it off once more, then after that you trade it higher and retrace once more again. So the thing is, you have identified that, breakout is a recipe for disaster in current market conditions. Then you want to trade pullback. Then the area that you identified where price may pull back to sometimes just doesn't come to your level. So basically, what you are actually doing right now is just seeing that your breakout trades are usually a failed attempt. Your pullback areas where you expect price to bounce up from isn't working out as well because price doesn't come to your level. So say for example, this is a key support area I've identified. I'm hoping for price to, perhaps come into this area, give me a chance to get long. But again, what you notice is that price just doesn't come into that area. You see that price instead just did a slight retracement, rally higher once more, did a slight retracement, rally higher once more. At this point in time, you think, okay, maybe I'll push up my bids in the market. I'll start to queue at this support area instead. Then price retrace, but again, not sufficient enough for you to get triggered in this area as well. Then some traders may get frustrated. Then they say, you know what, I'll just trade the breakout. Then they trade the breakout over here once more, and they got stopped out again. So this market, the S&P 500, is a tough market, especially coming from a trend following perspective. So what is my take on it? My take is very simple. Stay out of this market. Stay out till price action shows you, a clearer view of where the market really wants to go. Because no doubt on the weekly chart, you see that price is actually still in an uptrend. But on the daily chart, if you were to execute your trades, you see that the pullbacks are very steep. The breakouts are usually false breakout. So my take on it is that stay out of this market for now. That will be the best way going forward. So that's my take on the S&P 500. As a trend follower, I'm actually on the sideline for this market. So up next, let's look at another market, right? The New Zealand dollar, which is, I would say, a much more tradable market for me. So this is the weekly chart of New Zealand dollar. And you can see, right, a series of lower lows and lower highs. So we have this strong impulse move lower. We have this quite a while consolidation. Then another break lower. Then we had this pretty steep retracement. And now we have another break lower towards the downside. So on the weekly chart, the bias is definitely to the downside, right? I'm looking for shorting opportunities. And on the 4 hour, here is where you get a clearer view of where you could actually look to time your entries better. So looking at the 4 hour chart, you can see that the 20 and 50 period moving average over here is acting as dynamic resistance. So whenever price comes into this value area over here, it is actually a shorting opportunity. So for me personally, I would want to short should price comes back into this value area once more. And just to share with you, right, on NFP last Friday, I got short when price took out this swing low over here. So I'm basically short on this market right now. But for those of you who are currently not short yet, I would say this area is potentially a shorting opportunity for you. And stop loss will go above the 50 EMA. Because right now you've seen that the 50 EMA, which is the blue line, is currently acting as a dynamic resistance. So if price does break out of the 50 EMA, by a certain margin that you can define, right? For me, I use a 2 ATR. If price breaks above the 50 EMA by 2 ATR, I will exit my trade. So this is my trade plan for the New Zealand dollar. And let's look at another trading opportunity. This is the chart of copper. And you can see copper, again, no doubt this commodity is in a downtrend. You see a series of lower highs. As well as, notice how price is actually, I wouldn't say really respecting the 50 EMA to the pip, but the 50 EMA does provide a reference that you can look, right? Did a false breakout, another false breakout, another false breakout. So the 50 EMA is something to watch for that could act as a potential dynamic resistance, but keep in mind that that resistance isn't a exact strong level. Price may have a tendency to break it out, do a false breakout before, dropping back into the downtrend to resume its downtrend. So let's see how we can actually trade this market. Looking at the 4 hour chart, right? Again, a very similar setup as the New Zealand dollar. You see trading opportunities where it is. This is the 20 period moving average. This is the 50 period moving average. Nothing magical about it. It's just that it's a way for me to identify the current market dynamic support and resistance. And for copper, this is currently acting as dynamic resistance. So again, if you want to trade this market, I'll say there is shorting opportunity for you if price does retrace back into this area. Stop loss again once more is outside of the 50 EMA. And profit target wise, it really depends on the type of trader you are. If you're a swing trader, you could look to book your profits if price retests back this swing low over here. If you're a position trader like me, a trend follower who likes to capture massive trends in the market, chances are you would continue to hold your trades as long as price continues to make lower lows and lower highs. So trade management is something very personal that depends on your trading style and depends on your personality. There's 101 ways to go about it, and in this video I couldn't actually cover what are the possibilities for you to manage your trade. But nonetheless, I hope this week's market analysis give you a few trading ideas on what you can look at for this week. With that, I wish you good luck and good trading. I'll talk to you soon.